Risk of loss is what must be mitigated. In recent history, this has included the losses presented by non-producing mortgages and foreclosed properties. The OCC and other regulatory bodies have identified the inadequacy of enterprise risk management, or ERM, as one of the primary causes of the credit crunch of 2008. Moreover, ERM must reach beyond the activities conducted by the servicer. Consider, for example, OCC Bulletin 2013-29. The Office of the Comptroller of the Currency, or OCC, expects a bank to practice effective risk management regardless of whether the bank performs the activity internally or through a third party. The ERM requires a documented look at three quantities. First, your company's assets, and here we're talking about the replacement value of those assets. Get a very complete list of all your assets, everything from pencils through computers to reputation, a very important asset. The second thing is the likelihood of loss of each asset, and expressed as a simple percent. Is it 80% likely to be lost? 50%? You get the idea. And the last thing is the controls that are presently in place to mitigate either the severity of potential loss or the likelihood that it will occur. For each control, you want to estimate its effectiveness in mitigating the associate risk, and this one too should be expressed as a percent. The product of those three quantities will produce your company's exposure to each identified risk. You can then prioritize the list according to that exposure. And then, starting with the top, additional controls can be considered to lower that exposure to levels within your company's risk tolerance.